If you own real Bitcoin, your own wallet, your own keys, can anyone take it? No, not even the government. That's the whole point. Now, here's what the ETF prospectus actually says. If the custodian goes bankrupt, your shares become an unsecured creditor claim. You know what that means? You stand in line behind every lawyer, every bank, every person the custodian owes money to. Maybe you get scraps. The iShares Bitcoin Trust prospectus, BlackRock's ETF, literally says your assets could be treated as general unsecured creditor claims, leaving investors exposed to potential loss. That's not me guessing. That's the legal document you sign. And here's the kicker. Over 85% of all Bitcoin ETF assets are held by a single custodian. Coinbase, BB credit rating, junk status. 1 point of failure. So I'll ask you again. The ETF is a certificate that says we promise you own something. Bitcoin is the actual thing. Which one do you actually control? In this video, I'm going to show you exactly why the digital gold narrative is dead, why Wall Street didn't adopt Bitcoin, they neutered it, and why the thing you think you own in your brokerage account is not Bitcoin. It's digital paper, a derivative, a promise that can be broken. By the end, you'll understand the machinery that turned the most revolutionary financial asset of our generation into just another Wall Street casino chip. And more importantly, you'll know the one thing you can still do to actually own the real thing and protect it from every bank, government, and custodian that wants to take it. I'm Adalyn, and I'm not a crypto bro with a Lambo. I'm the girl who bought Bitcoin at $19,000 in 2021 and watched it crash. I held because I believed the promise. When the ETFs launched, I'd almost bought in. It felt safe, regulated, mature. But then my husband asked one question. Do you actually own the Bitcoin? I called my broker, I read the fine print, and what I found made me realize Wall Street didn't kill crypto. They became crypto, and they're selling you paper dressed up as gold. Let's go back to 2008. The financial system melted down because banks packaged garbage mortgages into securities and sold them as safe investments. They called them CDOs, fancy name for a trash bag full of dog poop wrapped in gold foil. Then Satoshi Nakamoto released the Bitcoin white paper, October 31st, 2008. The whole point was to create money that didn't rely on any third party. No banks, no middlemen, no trust required. For years, that was the promise. Be your own bank. Not your keys, not your coins. It was rebellious, anti-establishment. Then the price went up, and Wall Street got hungry. Here's what the ETF salesman told you. What they said. Now you can buy Bitcoin in your 401k. Easy, safe, regulated. What actually happened? You don't own Bitcoin. You own shares of a trust that claims to own Bitcoin. 2 layers of separation. 3 if you count your broker. What they said? No more worrying about wallets, seed phrases, or getting hacked. What actually happened? You cannot move your Bitcoin. You cannot send it to another wallet. You cannot pay for anything with it. You can only sell it for dollars. You own a price ticket, not an asset. What they said, institutional adoption means price goes up. What actually happened? Wall Street didn't adopt Bitcoin. They neutered it. They turned a decentralized, censorship-resistant asset into just another ticker symbol that trades alongside Enron and Pets.com. Let me hit you with numbers, because math doesn't lie. As of March 2026, the spot Bitcoin ETFs hold over 1.1 million BTC. That's about 5.5% of the total supply. Sounds bullish, right? Wrong. Here's what the prospectus doesn't say on the first page. Most of these ETFs do not allow redemptions in actual Bitcoin. You sell your shares, you get cash. The Bitcoin stays in the custodian's wallet. That means the Bitcoin is effectively locked, removed from the network. It's not circulating, it's not being used, it's just sitting in a Coinbase vault, accumulating custody fees. And here's where it gets worse. Coinbase is the custodian for over 85% of all Bitcoin ETF assets. 85%. One company. BB credit rating. That's junk status. 2 notches above default. If Coinbase gets hacked, goes bankrupt, or has a custody event, your ETF shares become an unsecured creditor claim. You know what that means? You're not an owner. You're a creditor of a trust. You stand in line behind every bank, every lawyer, every institutional investor they owe money to. Maybe you get scraps. And if you think that can't happen, remember FTX, remember Celsius, remember BlockFi. Every single one of them said, "We custody your assets safely." Every single one of them left creditors holding receipts.
Let me take you to the graveyard. FTX. Customers thought they owned crypto. They had account balances. They had nice dashboards. Then the exchange collapsed. What did they get? A claim in bankruptcy court. 3 years later, some are getting pennies on the dollar. Celsius. Same story. Earn yield on your crypto. Then frozen withdrawals. Then bankruptcy. Creditors fighting over scraps. The ETF puts you in the exact same legal position. You are not an owner. You are a creditor of a trust. The only difference is the logo on the website. So when someone tells you the ETF is safer than self-custody, ask them, safer for who? For you or for Wall Street, who gets to charge you 0.25% every year to hold a piece of paper? Let me show you who profits from your ignorance. First, the ETF issuers. BlackRock, Fidelity, Grayscale, they charge you an expense ratio, typically 0.2% to 1.5% per year on 1.1 million BTC. That's hundreds of millions of dollars in annual fees for doing almost nothing. Second, the custodians. Coinbase charges custody fees. They hold the Bitcoin, they collect a check. Even if the market goes down, they get paid. Third, the brokers, your Robinhood, your Schwab, your Fidelity. They get order flow, trading fees, and the pleasure of locking you into their ecosystem. And what do you get? A receipt, a line item, a statement. No control, no ownership, no ability to move your money without asking permission. That's the machinery. That's the scam. They took the most revolutionary asset of our generation and turned it into another product to sell you. Now, before I reveal the most important step, the one thing that separates people who actually own Bitcoin from people who just hold a certificate. But first, let me show you the graveyard of people who trusted the system, the people who bought the ETF thinking it was the same as owning the real thing, and what happened when the custodian had a liquidity event. Because I'm about to tell you something that goes against every financial advisor's recommendation, and it might make you uncomfortable. Stay with me. Here's the truth that nobody on CNBC will tell you. If you want to actually own Bitcoin, not a certificate, not a promise, not a creditor claim, you have to self-custody. That means 1, buy Bitcoin on a reputable exchange that actually delivers the asset, not a CFD, not a futures contract, real Bitcoin. 2, move it to a wallet where you control the private keys, hardware wallet, paper wallet, open source software wallet, not an exchange wallet, not a brokerage wallet, your wallet. 3, never share your seed phrase with anyone, not your broker, not your advisor, not your cousin who knows crypto. That's it. That's the whole secret. It's not complicated, it's not risky if you follow basic security, and it's the only way to eliminate counterparty risk. Does it take 5 extra minutes? Yes. Does it require you to learn something new? Yes, but that 5 minutes is the difference between owning an asset and holding a receipt that can be taken from you overnight. So let me leave you with this. Bitcoin is not digital gold anymore. Not because the technology changed, but because Wall Street convinced you to accept paper instead of the real thing. The ETF is not an upgrade, it's a step backward and reintroduces every single risk that Bitcoin was created to eliminate. Counterparty risk, custody risk, seizure risk, bankruptcy risk. You can buy the certificate, you can pay the fees, you can hope nothing goes wrong. Or you can spend one afternoon learning self-custody, move your Bitcoin to your own wallet, and never ask permission from a bank or a broker again. The choice is yours, but don't say nobody warned you.